The greatest financial collapse in world history, what really happened in the 2008 crisis. Imagine waking up tomorrow morning and discovering that more than $30 trillion has disappeared from the global economy. Not because of a world war. Not because of a deadly pandemic. Not because of a massive natural disaster. But because millions of ordinary people could no longer make their monthly mortgage payments. Within months, some of the largest financial institutions on Earth collapsed. Wall Street descended into panic. Millions of families lost their homes, millions more lost their jobs, and governments around the world were forced to spend trillions of dollars just to prevent the global financial system from completely falling apart. But here's the question that almost nobody asks. If the warning signs were visible years before the collapse, why did banks, investors, credit rating agencies, and governments continue fueling the bubble instead of stopping it? The answer reveals one of the greatest stories of greed, overconfidence, and financial engineering in modern history. This is the complete story of the 2008 financial crisis. To understand how everything collapsed, we have to go back several years before the crash. In the early 2000s, the United States experienced one of the biggest housing booms in history. Owning a home wasn't just considered part of the American dream. People believed it was the safest investment anyone could make. House prices had been rising for years, and many Americans became convinced that real estate prices would continue climbing forever. Banks believed it. Investors believed it. Politicians believed it. Even economists believed it. Low interest rates made borrowing money incredibly cheap. Families who had never imagined owning a home suddenly qualified for mortgages. Demand exploded. As demand increased, prices climbed even higher. And rising prices convinced even more people to buy before homes became even more expensive. It became a self-feeding cycle. But behind this housing boom, something dangerous was happening. Banks began lowering their lending standards. Instead of carefully checking whether borrowers could actually afford their loans, many lenders focused on one thing: approving as many mortgages as possible. People with excellent credit received loans. People with average credit received loans. Even people with poor credit histories received loans. These risky mortgages became known as subprime mortgages. Some borrowers had no stable income. Some had no savings. Some couldn't even verify their earnings. Yet they still received hundreds of thousands of dollars in mortgage loans. Why? Because banks no longer cared about keeping those mortgages. Instead, they sold them. Thousands of mortgages were bundled together and transformed into financial products called mortgage-backed securities. Investors around the world purchased these securities because they appeared safe. After all, they were backed by American homes. Even if a few homeowners failed to make payments, most people believed the system would continue working. Then Wall Street made the system even more complicated. Investment banks created new financial products by combining different mortgage securities together. These products became known as collateralized debt obligations, or CDOs. Very few people truly understood how they worked. Yet billions of dollars flowed into them every single month. Perhaps the most shocking part of the story involved the credit rating agencies. Companies responsible for evaluating investment risk gave many of these complex securities the highest possible ratings. AAA. The same rating often given to the safest government debt. As a result, pension funds invested retirement savings into these products. Insurance companies bought them. Banks bought them. Universities bought them. Governments bought them. Around the world, investors believed they were purchasing safe assets. In reality, many were buying packages filled with extremely risky mortgages. But Wall Street still wasn't satisfied. Banks and hedge funds started making side bets on whether these mortgages would succeed or fail. These bets were made using financial contracts called credit default swaps. Imagine buying insurance on someone else's house. Now imagine buying insurance on that same house hundreds of times. Suddenly, one single mortgage could generate enormous financial bets worth many times more than the actual value of the home itself. The financial system was no longer simply financing houses. It had become one enormous global casino. Then everything changed. The Federal Reserve gradually increased interest rates. Monthly mortgage payments became more expensive. Many homeowners who had accepted adjustable-rate mortgages suddenly found themselves unable to afford their payments. Defaults began rising. Foreclosures increased rapidly. More houses entered the market. For the first time in years, housing prices stopped rising. Then they started falling. As prices declined, millions of homeowners discovered they owed more money than their homes were actually worth. Many simply stopped paying. Banks suddenly realized something terrifying. The securities they had sold around the world were losing value much faster than anyone expected. Investors rushed to sell. But almost nobody wanted to buy. No one knew what these securities were actually worth anymore. Fear spread through the financial system. Banks stopped trusting one another. Lending slowed dramatically. Credit markets froze. Businesses that depended on loans struggled to survive. Then came September 15, 2008. Lehman Brothers, one of the oldest and most respected investment banks in America, filed for bankruptcy. The news shocked global financial markets. Investors panicked. Stock markets crashed. Financial institutions around the world suffered massive losses. Some disappeared entirely. Others survived only because governments stepped in with emergency support. The crisis quickly spread far beyond the United States. European banks suffered enormous losses. Asian markets fell sharply. International trade slowed. Factories closed. Businesses reduced hiring. Millions of workers lost their jobs. Families lost retirement savings that had taken decades to build. Many people who had never owned risky mortgages suffered anyway because the global financial system had become deeply interconnected. Governments now faced an impossible decision. Allow major banks to fail and risk a complete collapse of the global economy. Or rescue the financial system using taxpayer money. The United States approved hundreds of billions of dollars in emergency bailout programs. Central banks injected trillions of dollars into financial markets. Interest rates were reduced to historic lows. Extraordinary measures prevented an even larger disaster. But they also created one of the most controversial debates in modern economic history. Should governments rescue institutions whose own reckless decisions caused the crisis? Or should they allow them to fail, regardless of the consequences? Even today, economists remain divided. Some argue the bailouts saved the global economy. Others believe they rewarded irresponsible behavior and encouraged future risk-taking. Regardless of which side you support, one fact remains undeniable. The 2008 financial crisis permanently changed the world. Banking regulations became stricter. Capital requirements increased. Risk management received greater attention. Central banks gained new responsibilities. Yet many experts continue warning that financial bubbles never truly disappear. They simply take different forms. History repeatedly shows that every major financial collapse begins with the same dangerous belief. This time is different. In 2008, millions believed housing prices could never fall. They were wrong. The greatest lesson from the financial crisis isn't simply about mortgages or banks. It's about human nature. When greed replaces caution. When complexity hides risk. When profits become more important than responsibility. Even the world's largest financial system can collapse with astonishing speed. Because markets don't fail in a single day. They fail after years of ignored warning signs. And the next great financial crisis will almost certainly begin the same way. Quietly. almost invisibly. Until one day, the entire world notices.